while the masses grow impatient watching prices drift sideways, mistaking inactivity for opportunity lost. The composite operator is quietly executing the most profitable phase of the campaign. What appears as market indecision is actually strategic accumulation, invisible absorption occurring beneath a carefully maintained price ceiling. The very boredom that drives amateur traders away is the camouflage professionals require to position before the inevitable markup. For example, you've been watching XYZ stock trade between 48.52 for 3 months. Your screen time feels wasted. Meanwhile, notice how volume quietly swells on down days, yet prices refuse to break lower. That's not weakness. That's systematic buying under distribution's disguise. The trap isn't the range. It's your interpretation of it. Let me explain what actually occurs during these so-called dull periods that drive the average trader to distraction. The composite operator, that coordinated force of large professional interests, cannot simply step into the market and purchase the enormous lines of stock required for their campaigns. Such crude buying would immediately alert every speculator watching the tape, driving prices skyward before the accumulation is complete. This defeats the entire purpose. Instead, the composite operator must work with surgical precision and infinite patience. Picture a narrow trading range, perhaps spanning weeks or months, where prices oscillate between well-defined boundaries. To the untrained eye, this appears as market indecision, a wasteland of opportunity where nothing of consequence transpires. The ticker moves, certainly, but it seems to go nowhere. Retail traders grow restless, their capital tied up in what they perceive as dead money. This perception is precisely what the professional interests require. You see, accumulation is not a single event, but a campaign executed across time. The composite operator must absorb every share offered by discouraged holders, by those who bought higher and now seek escape, by those rotating into seemingly more exciting opportunities. This absorption must occur without bidding up prices prematurely, for every dollar added to the accumulation cost reduces the eventual profit margin on the markup phase. Therefore, the range itself becomes the camouflage. Prices are permitted to rally toward the upper boundary, creating momentary hope, only to be met with carefully placed supply that prevents breakout. This supply often comes from the composite operator's own inventory, selling into strength to maintain the ceiling. Conversely, when prices probe the lower boundary, strategic buying emerges to prevent collapse. Not enthusiastic buying that would reveal intent, but measured support that absorbs supply while maintaining the appearance of weakness. The genius lies in the psychology manufactured within this range. Each failed rally attempt convinces more holders that resistance is insurmountable. Each test of support triggers stop losses and shakes out weak positions. The very monotony of the price action becomes a filter, separating those who understand market structure from those who chase movement. During this accumulation phase, the composite operator is quietly building a massive position. Shares transfer from impatient, uninformed hands to patient, informed hands. The longer this process continues, the more thoroughly the supply is absorbed, and the more explosive the eventual markup becomes when the professional interests finally permit prices to advance. What appears on your chart as wasted time, as congestion devoid of opportunity, is actually the most critical phase of the entire market cycle. The cause is being built, the foundation is being laid, and those who recognize accumulation for what it truly is position themselves alongside the smartest money in the market, while the masses abandon their posts just before the campaign begins in earnest. Now, if you are to succeed in reading the market correctly, you must understand that price alone will deceive you every single time. The untrained speculator watches prices dance up and down within a range and concludes nothing is happening. But I tell you emphatically, the tape never lies if you know how to read it, and volume is the language in which the truth is spoken. Consider what actually transpires during professional accumulation. When prices decline toward the lower boundary of the trading range, what do you observe on your volume records? If you are paying attention, and you must always pay attention, you will notice that volume expands significantly on these downward movements. The uninformed trader sees this and thinks, "Heavy selling! The stock is weak." This is precisely the conclusion the composite operator wants you to reach. But look more carefully at what follows. Despite this increased volume on the decline, prices do not collapse. They do not break decisively through support. Instead, they find sponsorship, they stabilize, they recover. This is the critical tell. Heavy volume on a decline that fails to produce lower lows reveals absorption. Someone of size is stepping in to take every share offered. The composite operator is using the fear and discouragement of the moment to accumulate inventory without competition. Contrast this with what occurs during the rallies within the same range. Prices advance toward the upper boundary, creating hope and attracting some buying interest. But examine your volume carefully here. What do you see? Diminished activity, light volume. The rally lacks the participation that would characterize genuine public demand. This tells you that supply is controlled, that the upward movement is being permitted rather than driven by enthusiastic buying. This divergence between price behavior and volume characteristics is your window into the composite operator's intentions. They are not broadcasting their activities through advertisements in the financial press. They are revealing their hand through the only honest medium available, the actual transactions occurring in the marketplace, recorded as volume. I have studied thousands of trading ranges across decades of market observation, and this pattern repeats with remarkable consistency. Accumulation zones show you swelling volume when prices test support, absorption of supply. They show you contracting volume when prices test resistance, controlled distribution to maintain the ceiling. These are not random occurrences. They are the fingerprints of intelligent, coordinated operations. The amateur trader ignores volume or misinterprets its significance. The professional tape reader makes volume analysis the cornerstone of market judgment. When you see a stock trading sideways for weeks with increasing volume on down days but prices refusing to break support, you are witnessing accumulation in real time. The composite operator cannot hide these footprints, though they try to disguise them within the noise of daily fluctuations. Train yourself to read volume as the measure of commitment, the gauge of institutional interest, the evidence of smart money positioning. Price tells you where the market is. Volume tells you what the market means. Master this distinction, and you will never again mistake accumulation for mere congestion. I want you to understand something fundamental about how the composite operator conducts their campaigns. They are not merely buying and selling stock. They are managing human psychology on a mass scale. And one of their most potent weapons is time itself, specifically your inability to endure it. Think about your own reactions when you commit capital to a position that subsequently does nothing. Day after day, the stock trades within the same narrow boundaries. Your money sits idle while opportunities seemingly parade past you in other securities. Friends tell you about their quick profits elsewhere. Your attention wanders. Doubt creeps in. The voice in your head whispers, "Perhaps I was wrong. Perhaps I should move this capital to something more active." This is not accidental. This is engineered. The composite operator understands perfectly well that the average trader operates on emotional fuel. Hope, fear, greed, impatience, these are the levers that move the amateur from one position to another, always at precisely the wrong moments. And impatience, I assure you, is the most exploitable of all these emotions in a sideways market. You see, professionals view time completely differently than you do. Where you see wasted days, they see necessary preparation. Where you see opportunity cost, they see strategic positioning. They have the capital reserves to wait indefinitely. More importantly, they have the psychological discipline that comes from understanding market structure. They know that accumulation cannot be rushed any more than you can rush the harvest by pulling on the crops. So they deliberately create conditions that test your patience to its breaking point. They keep prices compressed for weeks, sometimes months. They allow just enough upward movement to keep some hope alive, then crush it with a return to the range. They permit just enough downward pressure to trigger your fears, then stabilize before real damage occurs. This oscillation within the range serves a specific purpose. It shakes you out, and shake you out it does. One by one, traders who entered the range with conviction exit in frustration. Their capital flows to what appears more promising. They tell themselves they will return when the stock starts moving. This is precisely the transfer of shares from weak hands to strong hands that accumulation requires. The beautiful irony, and I say this having watched it unfold thousands of times, is that the very boredom that drives you away is the signal that accumulation is progressing exactly as planned. The sideways action is not a malfunction. It is the mechanism. The composite operator needs your impatience. They cultivate it. They depend upon it to clear the market of uncommitted holders before the markup phase begins. Time becomes their ally because it is your enemy. The longer they can maintain the range, the more thoroughly they can accumulate, the more weak hands they can eliminate, and the more explosive the eventual move becomes. So I ask you, who is trapping whom? The market is not trapping you in a sideways range. Your own impatience is trapping you into abandoning your position just as the professional campaign reaches completion. Master your psychology, and you transform from victim to participant in the composite operator's plan. Let me draw your attention to some of the most revealing and most misunderstood phenomena that occur during these sideways movements. The composite operator does not simply sit passively within a trading range, quietly accumulating shares. No, they actively probe and test the market, conducting what I call tactical experiments to determine precisely what lies ahead before committing to the markup phase. Watch closely what happens after a stock has traded sideways for some time. Suddenly, without apparent cause, prices break sharply below the established support level. The move looks decisive. Stops are triggered. Bears pile on, certain the bottom has fallen out. Volume may spike as panic sellers rush to exit. This, my friend, is what I call a spring. And it is one of the most valuable signals in all of technical analysis, if you know how to read it correctly. But observe what follows this downside violation. Instead of continued collapse, instead of the avalanche of selling that should accompany a genuine breakdown, prices quickly recover. Within hours, or perhaps a day or two, the stock is back inside the original range, often closing near where it started. What has occurred here? The composite operator has conducted a test. They have deliberately pushed prices below support to gauge how much selling remains in the market. How many weak holders were still clinging to their positions? How many stop-loss orders were resting just below the range? More importantly, after shaking out this supply, how readily did prices recover? A quick recovery on the spring tells the professional interests everything they need to know. The supply has been largely exhausted. The market is ready for markup. Now consider the opposite scenario. Prices thrust upward, breaking above the resistance level that has capped rallies for weeks. The move appears genuine. Bulls become excited, thinking the breakout has finally arrived. But then, just as suddenly, the advance fails. Prices retreat back into the range, often closing weak. This is what I term an upthrust. And it serves a different but equally important testing function. The composite operator has probed overhead supply. How much stock comes out at higher prices? Are there sellers eager to unload inventory the moment prices rise? An upthrust that meets heavy supply tells the professionals that more work remains, more accumulation, more time, more shakeouts may be necessary before markup can succeed. These tactical maneuvers within the range are not random price gyrations. They are deliberate reconnaissance missions. The composite operator is mapping the battlefield before committing their forces. Each spring tests downside supply. Each upthrust tests overhead resistance. Together, these tests reveal the market's readiness for directional movement. The amateur trader sees these moves and feels whipsawed, confused, possibly angry at the manipulation. The professional trader sees these same moves and recognizes preparation. When you observe a spring followed by strong recovery, you are witnessing the final stages of accumulation. The trap has been sprung on the bears, the weak hands have been cleared, and the campaign is nearly ready to advance. Learn to recognize these tests for what they are, not betrayals of your position, but confirmations of the composite operator's intent. They are the reconnaissance that precedes the real move. There exists a fundamental law governing market movements that, once you truly grasp it, will transform your entire approach to speculation. I call this the law of cause and effect, and it operates with the same reliability in the stock market as the laws of physics operate in the natural world. Simply stated, the extent of the cause determines the extent of the effect. Or, in practical terms, the amount of accumulation, measured in both time and volume, directly determines the potential of the subsequent advance. Let me explain this clearly, for it is crucial to your success. When you observe a stock trading sideways for 3 months within a narrow range, you are not witnessing 3 months of wasted time. You are witnessing the building of cause. Every share that changes hands during this period, every transaction recorded on the tape, every test and retest of support and resistance, all of this activity is creating the energy, the potential, the foundation for the move that will eventually emerge. Think of it as a coiled spring. The longer the compression, the more powerful the eventual release. The composite operator cannot accumulate a large position in a few days without driving prices sharply higher. They require time. They need the market to forget about the stock, to become disinterested, to move on to other opportunities. Only under this cover of indifference can they systematically absorb the supply necessary for their campaign. Now, here is where most traders fail in their analysis. They see a stock break out of a 3-week range and assume it has the same potential as one breaking out of a 3-month range. This is fundamentally incorrect. The 3-week range has built a small cause. Perhaps it supports a move of 10 or 15% before the composite operator must distribute their modest holdings. But the 3-month range, that extended period of accumulation, has built substantial cause. The position accumulated is large. The potential effect, the markup, must be proportionally significant to allow the distribution of such inventory at a profit. I have measured countless trading ranges across every type of market condition, and this relationship holds with remarkable consistency. The width of the range matters, certainly. A wider range allows more shares to change hands at varying prices. But the duration is equally critical. Time allows for the complete transfer of supply from weak to strong hands. Time allows for the exhaustion of selling pressure. Time allows for the construction of a position so substantial that only a major advance can justify the effort and risk undertaken. This is why patience during the sideways phase is not merely a virtue. It is a strategic necessity. The market is quite literally building the energy for the next directional move. You cannot skip this phase. You cannot rush it. The cause must be built before the effect can manifest. So when you find yourself frustrated by a stock that has traded sideways for months, ask yourself this: what kind of cause is being built here? What magnitude of effect might such extended accumulation support? The very duration that tests your patience is creating the profit potential that will reward it. The composite operator understands this law perfectly. They are willing to spend months building cores because they know the effect will justify the investment of time and capital. Master this law, and you will never again mistake a sideways market for lost opportunity. You will recognize it for what it truly is, the construction phase of the next substantial move. Now, let me bring all of this together for you, because understanding these principles individually is valuable, but seeing how they interconnect is what separates the professional from the perpetual amateur. The sideways trap is not a trap set by the market, it is a trap you set for yourself through ignorance of how markets actually operate. While you stand impatiently on the sidelines, complaining about inaction and searching for greener pastures, the composite operator is conducting the most important work of their entire campaign. They are accumulating position, testing supply and demand, engineering the psychological conditions necessary for transfer of ownership, and building the cores that will produce the effect you will later chase at much higher prices. Every principle I have shared with you today works in concert. The accumulation disguised as congestion provides the operational theater. Volume analysis gives you the evidence of what is truly occurring beneath the surface. The weaponization of your impatience clears the market of weak holders. The tactical tests, springs and upthrusts, confirm readiness for the next phase, and the law of cause and effect guarantees that the time you consider wasted is actually building the profit potential you seek. Here is what I want you to take from this: the market rewards those who understand its structure, not those who react to its superficial movements. When you see a stock trading sideways, your first question should not be, when will this finally move? But rather, what is being built here? Is volume expanding on declines while prices hold? That is absorption. Are weak hands growing frustrated and exiting? That is transfer. Has the range persisted long enough to build substantial cores? That is potential. The choice before you is simple but profound. You can continue to view sideways markets as obstacles to be avoided, traps that waste your time and capital. Or you can learn to read them as the professional does, as opportunities to position alongside the smartest money in the market during the very phase when they are most actively at work. I have given you the tools. I have shown you what to look for. The springs that shake out the bears, the volume patterns that reveal accumulation, the psychology that drives weak hands away, the time investment that builds explosive potential. These are not secrets hidden in darkness. They are written plainly on every chart, recorded in every volume bar, visible to anyone willing to study the tape with patience and discipline. The composite operator will continue to operate exactly as I have described, for these methods have worked for generations and will work for generations more. The question is not whether the trap will be set. It will be. The question is whether you will be caught in it, or whether you will recognize it for what it is and position yourself on the right side of the operation. Study the sideways market. Respect its purpose, read its language, and when others flee in boredom and frustration, stand firm with the knowledge that causes being built. The effect will come. It always does. And those who understood the process will profit, while those who ignored it will wonder how they missed such an obvious opportunity. This is the difference between speculation and investing with knowledge. Master these principles, and you transform from a trader hoping for movement into a student of market structure who recognizes opportunity precisely when it appears most absent.